In the grand theater of global power politics, few rivalries have reshaped the 21st century economic order as dramatically as the US-China trade war. What began as a dispute over tariffs has evolved into a contest over technology, supply chains, military advantage, and ultimately, global leadership. To understand this conflict, we must move beyond slogans and look closely at its origins, its present reality, and where it may lead. The story formally ignited in 2018 under the administration of then U.S. President Donald Trump. On March 22, 2018, the United States announced tariffs on approximately $50 billion worth of Chinese imports under Section 301 of the Trade Act of 1974, accusing Beijing of intellectual property theft and forced technology transfers. By July 6, 2018, the first tranche of tariffs had taken effect. China responded immediately with retaliatory tariffs on American goods, from soybeans to automobiles. Thus began a cycle of escalation that shook financial markets and sent shockwaves through global supply chains. At its core, the trade war was about much more than trade deficits. For decades, the United States had accused China of unfair industrial policies, including state subsidies for domestic firms, barriers to foreign companies, and systematic appropriation of intellectual property. Washington argued that China's rise was not purely market-driven but state-engineered. At the same time, China, under President Xi Jinping, was pursuing ambitious initiatives such as Made in China 2025, aiming to dominate advanced industries like semiconductors, robotics, artificial intelligence, and green technology. In Washington's eyes, this was not just economic competition, it was strategic rivalry. The causes were layered. First, there was the massive U.S. trade deficit with China, which exceeded $375 billion in 2007. For American policymakers, this imbalance symbolized lost manufacturing jobs and hollowed out industrial towns. Second, there was technology theft, real or alleged. American intelligence agencies and corporations repeatedly accused Chinese entities of cyber-espionage and intellectual property violations. Third, there was national security. The rise of Chinese tech giants triggered fears in Washington that control over 5G, artificial intelligence, and rare earth supply chains would translate into geopolitical leverage. Then came the technology front. The trade war quickly expanded into what many now call a tech war. In May 2019, the United States placed Huawei on the Entity List, restricting its access to American technology. Similar restrictions later targeted semiconductor exports, advanced chip-making equipment, and high-performance GPUs essential for AI development. This was no longer about soybeans or steel, it was about who controls the commanding heights of the digital age. The Phase 1 agreement signed on January 15, 2020, appeared to de-escalate tensions. China pledged to purchase an additional $200 billion of U.S. goods over 2 years and strengthen intellectual property protections. But the deal left most tariffs in place. Then the COVID-19 pandemic hit, disrupting global trade and undermining purchase commitments. Trust eroded further as both nations traded accusations over the virus's origins and transparency. Under President Joe Biden, many expected a reset. Instead, the strategy shifted from unilateral tariff pressure to coalition building and targeted technological containment. Tariffs largely remained. In October 2020 and beyond, the U.S. tightened export controls on advanced semiconductors and chip-making equipment to China, citing national security concerns. In response, China accelerated efforts toward technological self-reliance and enacted its own export controls, particularly on critical minerals such as gallium and germanium, materials vital for high-tech manufacturing. Today, the manifestations of the trade war are woven into everyday economics. Multinational companies are diversifying supply chains in a strategy often described as China Plus One, shifting production to countries like Vietnam, India, and Mexico. American firms face stricter scrutiny when investing in Chinese tech sectors. Chinese companies, meanwhile, are building domestic alternatives to Western technologies. The global economy is fragmenting into partially separate spheres of influence. The domestic impacts have been mixed and politically contentious. In the United States, tariffs were intended to revive domestic manufacturing and protect jobs. Some sectors, such as steel, temporarily benefited from protection. Yet American consumers and manufacturers also bore higher costs, as tariffs functioned as taxes on imports. U.S. farmers, particularly soybean producers, suffered from retaliatory Chinese tariffs and required billions of dollars in federal subsidies to offset losses. Inflationary pressures, especially during pandemic recovery years, intensified debates over whether tariffs contributed to rising consumer prices. In China, the government absorbed shocks through state support for affected industries and stimulus measures. Export diversification reduced reliance on the American market, while domestic innovation policies intensified. However, slower economic growth, property market crises, and rising youth unemployment have tested Beijing's economic resilience. The trade conflict added another layer of strain to an already transitioning economy. Globally, the trade war has unsettled the foundation of the World Trade Organization system. Rules-based trade has increasingly given way to national security exceptions and strategic industrial policy. Allies of the United States such as the European Union, Japan, and South Korea find themselves balancing economic ties with China against security partnerships with Washington. Emerging economies see opportunity in supply chain relocation but also vulnerability in being caught between two superpowers. This is no longer merely a tariff dispute. It is a systemic rivalry touching finance, technology, military alliances, cyber operations, and even academia. Sanctions, investment screenings, export controls, and industrial subsidies have become instruments of power. The term decoupling once sounded extreme. Today, policymakers speak more cautiously of de-risking, yet the direction remains clear: strategic separation in critical sectors. What does the future hold? A full economic divorce between the world's two largest economies is unlikely. Trade volumes remain enormous, and both nations depend on each other in complex ways. However, selective decoupling in high-tech sectors will likely deepen. Artificial intelligence, quantum computing, green energy supply chains, and advanced semiconductors are now arenas of geopolitical competition. The outcome may shape the architecture of global order. If competition remains managed, it could stabilize into a long-term cold economic rivalry with guardrails. If mismanaged, it risks spilling into financial crises or even military confrontation, particularly over sensitive flashpoints like Taiwan. Business leaders, meanwhile, operate in a world where compliance teams rival strategy departments in importance. Ultimately, the US-China trade war reflects a deeper historical transition. For decades, globalization was powered by integration, supply chains span oceans, capital flowed freely, and growth seemed to bind nations together. Today, security concerns and power politics are reshaping those linkages. The trade war is not an isolated episode, it is a symptom of a shifting balance of power between a reigning superpower and a rising challenger. In investigative terms, the evidence points to one conclusion: this is not a temporary skirmish but a defining struggle of our era. Tariffs may fluctuate, leaders may change, agreements may be signed, but the structural competition between Washington and Beijing appears set to endure. The question is not whether the conflict will continue, but how the world will adapt to an age where economics and geopolitics are once again inseparable.